The CARES Act PL 116-136, provisions designed to help banks and credit unions. Updated January 11, 2021. The economic effects of the coronavirus COVID-19 pandemic may cause numerous borrowers to miss loan repayments, potentially leading to distress at banks and credit unions. Because of the importance of those institutions to the economy, regulators have implemented safety and soundness regulations, including lending, capital, and liquidity rules. Regulators also require the institutions to report financial information. As part of Congress's response to COVID-19, the Coronavirus Aid, Relief, and Economic Security Act (CARES Act) PL 116-136 includes 4 sections: 4011, 4012, 4013, and 4014, that temporarily relax some of the regulations banks face. Section 4016 expands access to the Central Liquidity Facility, CLF, which is a liquidity facility for credit unions that is administered by the National Credit Union Administration. This insight examines those sections. For descriptions of all sections of Title IV of the CARES Act, see CRS Report R46301, Title IV Provisions of the CARES Act PL 116-136. Sections 540 and 541 of Division N of the Consolidated Appropriations Act, 2021 PL 116-260 extended the expiration of Sections 4013, 4014, and 4016, as discussed in CRS Insight IN11568, CARES Act Bank and Credit Union Relief, Expirations and Extensions under PL 116-260. Policymakers have implemented other measures addressing concerns related to financial institutions. The CARES Act expands the Federal Deposit Insurance Corporation's authority to guarantee bank liabilities, as described in CRS Insight IN 11307, the CARES Act PL 116-136, Section 4008, FDIC Bank Debt Guarantee Authority. CRS Insight IN 11278, Bank and Credit Union Regulators' Response to COVID-19, describes the actions taken by depository regulators under existing authority to address issues in the banking industry. CRS Insight IN 11259, Federal Reserve, Recent Actions in Response to COVID-19, discusses the programs the Federal Reserve has set up to provide liquidity to financial markets. OCC Lending Limit Waiver. National banks are subject to limits on how much they can lend to a single borrower relative to their capital and their portfolio characteristics, unless the loan qualifies for an exception enumerated by statute. The Office of the Comptroller of the Currency (OCC) generally has relatively narrow authority to approve certain loans for an exception to the limit. Section 4011 grants the OCC broad authority to exempt loans when it is in the public interest. This authority expired on December 31, 2020. Small bank capital relief. Banks face a variety of requirements regarding how much capital they must hold to protect against possible losses. Capital is a relatively expensive source of funding, and so requiring higher levels can reduce the amount banks lend. Certain small banks can elect to be subject to a single, relatively simple, but relatively high, capital rule called the Community Bank Leverage Ratio (CBLR). Bank regulators are authorized to set the ratio between 8% and 10%. Prior to the enactment of the CARES Act, it was set at 9%. Section 4012 directs regulators to lower it to 8% and to give banks that fall below that level a grace period to come back into compliance with the CBLR. Section 4012's mandate expired on December 31, 2020. The rule issued by bank regulators lowered the CBLR to 8% through the end of 2020 in accordance with Section 4012. In addition, it raises the CBLR increments to 8.5% in 2021 before returning it to 9% on January 1, 2022. Accounting for troubled debt restructuring. A troubled debt restructuring (TDR) is a concession by a lender to a troubled borrower that it would not generally consider under normal circumstances. Generally Accepted Accounting Principles (GAAP) require the lender to reflect in its financial records any potential loss as a result of a TDR. Recording of such losses could negatively impact the lender's ability to meet regulatory requirements. Section 4013 requires federal bank and credit union regulators to allow lenders to determine if they should suspend the GAAP requirements for recognizing any potential COVID-related losses from a TDR related to a loan modification. This relief expires the earlier of 1. The termination date of the COVID-19 national emergency declared by the President on March 13, 2020, under the National Emergencies Act, PL 94-412, or 2. The end of 2021, extended from the end of 2020 pursuant to PL 116-260. Accounting for expected loan losses. Credit loss reserves help mitigate the income overstatement on loans and other assets by adjusting for potential future losses on related loans and other assets. In response to banks' financial challenges during and after the 2007 to 2009 financial crisis, the Financial Accounting Standards Board promulgated a new credit loss standard, Current Expected Credit Loss (CECL), in June 2016. CECL requires early recognition of losses as compared to the current methodology. All public companies were required to issue financial statements that incorporated CECL for reporting periods beginning December 15, 2019. Section 4014 gives banks and credit unions the option to temporarily delay CECL implementation until the earlier of 1. The National Emergency Termination Date, or 2. The end of 2021, extended from the end of 2020 pursuant to PL 116-260. On August 26, 2020, the bank regulators finalized an interim rule allowing banks to delay CECL's adoption for up to 2 years, longer than the Section 4014 mandate. The new CECL rule also delays the accumulation of regulatory capital by 2 years. As before, the new CECL rule allows accumulation of regulatory capital to meet CECL's requirements over 3 years after the initial 2-year delay. Credit Union Liquidity Facility. Section 4016 temporarily expands access to the CLF for credit unions to meet liquidity needs so long as credit unions first made reasonable efforts to use primary sources of liquidity, such as their balance sheets and market funding sources. Section 4016 also increases resources available to meet liquidity needs through the facility by temporarily expanding the ability to borrow up to a value 16 times the CLF's subscribed capital stock and surplus, up from the statutory limit of 12 times. Section 4016 provisions expire at the end of 2021, extended from the end of 2020 pursuant to PL 116-260. Author information: David W. Perkins, Specialist in Macroeconomic Policy; Daryl E. Getter, Specialist in Financial Economics; Raj Nanaraja, Analyst in Financial Economics.